Chris, it's all you on trading psychology.
Excellent. Thank you, Todd. And Todd, Dan, Brian, great presentations thus far today. Also want to say thanks to Marcus and Nelson internally who have been such great help for helping us put together this event. And I appreciate that introduction, Todd. DailyFX has literally been the only place that I've worked. I've come up through the ranks as an intern from 2008. And so I've learned a lot about how markets tick, not just from the inside of a brokerage, but also as a market participant myself. And hearing a lot of these conversations today, we're talking about how to approach the market, very technically. This session is not really about approaching the market, however. It's more about how to approach yourself. I think one of the most overlooked aspects of trading is that you're not necessarily even trading against the market or other people. You're trading against your emotions. You see, when you have a plan, you have a strategy, you need to stick to it. There are going to be times when along your journey you come to a pothole in the road, or you hit turbulence in your flight, and that doesn't mean that you go off course. You need to have the confidence to know that the system you've built will continue to carry you through those rocky ways. And just like a good system, we need to develop mental resiliency when we approach markets. So as we discuss this particular field of behavioral finance and everything within, I want to remind you that while this is somewhat dense with a lot of overlapping terms and extensive vocabulary, this material is mostly non-technical. Math is incidental here. We really want to stay away from trying to build applied mathematics models of how people think and really delve into how we actually behave and operate as human beings first and foremost. Before we get started, of course, I do need to do the obligatory risk disclosures and disclaimers. And I would like to remind everyone personally that any opinion I disseminate is mine and mine alone, of course, does not constitute trading advice on behalf of DailyFX, IG Group, or Nadex in that regard. As we go through the course of this presentation, you'll hear a number of my opinions, and I'd like for you to be aware that those are my opinions. But some of what we will be discussing, of course, is grounded in empirical evidence derived from studies, reviews of portfolio performance, looking at how individuals, both at a micro level as retail traders to macro level, say institutions or governments, behave. And so over the course of today, we're going to cover 6 different areas, 6 different themes. First here, behavioral finance versus traditional finance. Let you know what 2 worlds we're actually operating in. We're going to talk about the efficient market hypothesis and why you may think it's valid or invalid. We're going to talk about the different approaches, the psychological approaches to portfolio construction. And believe it or not, you are doing these things whether you realize it or not. We'll go into the biases of individuals, the hurdles, the obstacles that you will face in the course of your decision-making when operating in financial markets. And we're going to talk about figuring out what kind of trader you are. I'll share some of my successes and failures, perhaps, and certainly the failures speak louder than the successes, at least those stick out to me more. And those are the best learning tools. So we'll get to that section and the DNA FX quiz in part 5, and then part 6, we'll talk about when our biases are left unchecked, how we get manias and financial bubbles. But let's start to delve into this because we have a lot to cover here. Behavioral finance versus traditional finance. These are really 2 different models of viewing the world. They're different in both perspective and in perception. Traditional finance is a stipulation of what we should be doing. And the underlying idea here is that you'll hear this in economic textbooks, but ceteris paribus, all things else held equal, individuals are rational operators. They're rational economic men and women in the market, which means as rational creatures, we are able to maximize our present value of weighted average utility at all times. We are able to operate without any limits on our ability to process or absorb information. And because we know everything that's going on over time, we generally speaking, we tend to get more risk averse as the days and years go by. And by nature of this particular ordering of the world, markets tend to be very efficient. They're perfectly efficient, actually. I'm here to dissuade you that the traditional finance view of the world is the correct one. I think that it's more akin to the behavioral finance view of the world, which is a mode of interpreting events or investing decisions in the manner of which how we behave rather than what we should be doing. You see, investors aren't always risk averse, which is one of the tenets of your classic, CAP-M model, Miller-Modigliani, figuring out what the actual value of a given asset is. That's, unfortunately, not all investors are risk averse. Some are risk seeking. Some are risk neutral. When I say risk seeking, for example, do you think the people on the Wall Street Bets forums taking their stimulus checks and YOLOing it, in lack of a better term, on GameStop calls are risk averse investors? Well, that type of behavior just doesn't fit in with a traditional finance view of the world. And I think we're aware of that. And so when we talk about behavioral finance, we're trying to figure out why we're doing what we're doing. We're trying to understand what we've done, how it differentiates on an individual level from what we should actually be doing, right? The process that we've outlined ahead of time versus their actual results. What causes that differentiation? When we talk about things on a bigger level, though, because individuals make up institutions and institutions end up driving the markets, we tend to have large inefficiencies that can result over time. And these large inefficiencies ultimately yield us with the end goal, the end result at least, of believing that markets are not always efficient. Now, before we go into the efficient market hypothesis, we do need to talk about this idea of utility here. Utility is the idea that investors have a diminishing marginal return for taking risk and or, in this case, the amount of happiness, the gain, so to speak, that they get from making more money, right? The first few dollars you make, you'll get a lot of utility out of it. But the incremental $100th, the $1,000th, the $1,000,000th, the $1,000,000,000, the $1,000,000,000,000, if you will, those matter less and less, right? And so the idea behind utility theory in traditional finance is that investors are risk adverse. And as a result, with having a concave utility function, they take a mindset that they would pay less than, say, $100 for an uncertain but expected payout of 100. That really doesn't make a lot of sense, right? But that is the world in which we operate. Utility theory suggests that investors gain utility as wealth increases, but at a decreasing rate. But this is only for risk-averse investors. And we know that there are different types of investors besides just risk-averse ones. Like I said before, there are three types of investors in this world: risk-averse, risk-neutral, or risk-seeking. Now, let's just start with an assumption here. Each type of investor has the same expected return profile. It's the tolerance of risk that differentiates them. A risk-averse investor, all else being equal, let's say we can invest in stocks or bonds, we're going to get the same exact return. They're going to choose bonds most likely. Why? Historically speaking, bonds have the lower standard deviation of returns. In a risk-neutral mindset, they don't really care what they're investing in, quite frankly, as long as they have the ability to achieve that return. If bonds are going to give me a total return of 10%, or investing in the S&P 500 and reinvesting dividends will give me an annualized return of 10%, 6 of one, half a dozen of the other. It doesn't matter. And as a result, we have investors with linear marginal utility returns, curves, excuse me. And finally, you have your, Reddit, GameStop trading types, the risk-seeking types. All else equal, if they have two choices, they can take an investment that's going to return 10% and another that will return 10%, but one has a much greater chance of going belly up. They're actually going to take that. And they're going to take that because they have increasing marginal utility. They have a convex utility function, which means the more money they make, the better they're doing, the happier they are, the more that they're getting out of their life, so to speak. This is a really important point to think about. When individuals are operating in a risk-seeking mindset, it totally undercuts the notion that markets are behaving in an efficient manner. Because if investors are going out there and seeking the highest risk asset given any level of expected return, it ultimately means that they're going to be safer assets that are undervalued, that can provide similar levels of success in terms of achieving total return, that maybe, say, have a lower valuation, a lower price, a lower PE. It causes distortions in markets. It causes valuations to get out of whack. That may sound familiar to something that we're dealing with today in markets, where historically speaking, you talk about PE ratios going back to 1945, and average PE ratios for the S&P 500 oscillate in that 15 to 20 range. And yet here we are at 35 right now. Investors are getting more utility right now out of the market the higher the market goes, and the higher the market goes, the more likely that it'll be drawn in. It's an important rationalization of the behavior that's going on, because it means that investors are no longer seeking to do the thing that will provide them the return in the safest manner possible. They're approaching markets like it's a bit of a casino, like it's a bit of an entertainment value. Now, I will say that an individual investor may go through various phases of seeking utility over the course of their trading life cycle. And you may recognize this in your own results. At first, you start off and you want to protect your capital. And then all of a sudden, you get a little bit of success and you start taking a little bit more risk. All of a sudden, you sit on a bigger pile of money and you go, wait. Now I've got to protect this again. This is actually something that happens to regular people, to the average person. It's known as the Freeman-Savage double utility function. We actually see that at lower levels, individuals tend to be risk averse. And when we achieve some modicum of success, we start to play the hot hand. And if we are able to achieve and maintain a level of success for a period of time, we actually then become more protective and conservative with our risk seeking, because we then value what we have achieved. What we want to avoid is preventing our curve from falling back over. The goal here is to prevent cognitive and emotional biases that filter in during the switch, during the inflection point, from leading to suboptimal outcomes. And so we're going to talk about some of those biases in a little bit. But before we do, there is another layer to this discussion around utility here. And it's this idea that we are, as individuals, operating not on actual numbers, but on feelings. We have perceptions of gains and losses in wealth that actually matter more than your level of wealth. We feel the gain of $100, 100 pounds less than we feel the loss of the equivalent $100 or 100 pounds. I think that's a really interesting insight into human psychology, because it means that we are operating on making decisions that please us, that provide us satisfaction, that provide us satisfice, rather than doing what's optimal or providing us maximal utility. You know the expression, you got to cut your losers and let your winners ride. Why? Because the natural inclination is to take your small win and stick out your loss until it eventually turns around. You don't want to admit you're wrong, which is why we feel losses more, because it's a check on our ego. When we're right, we want the win. And you know what? We've actually seen this borne out in our IG climate sentiment data. IG has been so great about sharing some of this information with DailyFX and putting out in the public something that few other brokers, in fact, I don't want to say no other broker does because I can't confirm that, but I don't think many other brokers do this. We are unique in that regard. And this is a really good thing, because when we look at FX markets, they're decentralized. There's no New York Foreign Exchange, right? Like the New York Stock Exchange or NASDAQ. What we have are a bunch of different brokers and banks and dealers, intermediaries operating across electronic networks. And we only get volume data on positioning once a week from the CFTC and their COP report. And that report's released on Friday afternoons, but the reporting period ends the prior Tuesday. So anything that happens Wednesday, Thursday, Friday in the markets is not reflected in the weekly COT update. So with IG's client sentiment index, we are actually able to get real-time updates on positioning Now, granted, IG is not, the market. It is a small fish in this very big pot of foreign exchange, trillions of dollars of turnover, notional volume daily. But it does give us insight into how people behave. And what we see from our IG client sentiment index data is that investors, traders with the firm, if you're to do binary, did they make money or lose money? They make money more often than not, 53% of the time. From my last review of the data, traders were making money on any given trade. The problem is that it was the depth of the gains or losses that ultimately determined if they were successful. The average trader on Eurodollar, for example, was taking a loss twice the size of their gain. If you're going to take losses twice the size of your gain, and I apologize, here's some math, but that means you need to be right 2/3 of the time. You have to be right 67% of the time in order to take losses twice the size of your winners in order just to break even. Now, I'm a baseball fan. I'm a New York Mets fan, which is terrible most of the time. This year, maybe not. But as anyone who watches baseball knows, the best hitters in the world are hitting 300. 30% of the time they're getting a hit. That's really how you be approaching markets here. You don't want to have this type of curve where we are letting our losers ride out and taking small winners. We want it the other way around. We don't care if we're right. We want to make money. We have to set our egos aside and recognize that, yes, we're going to feel the loss. And by not cutting our trade at our point where we are supposed to cut our trade at our stop level, we're actually doing the thing that we should not be doing. We're giving in to our innate human psychology, which is to tell us we cannot accept defeat. We cannot take the loss. Our ego can't stand it. So we'll ride it out until we get to break even. Whereas on the other side, all we want to do is knock down wins. So in thinking about prospect theory, about how we operate, this suggests that individuals, me, you, everyone, we all have limitations to our abilities to absorb and process information. And I think that's really important. I mean, we are making decisions based on limits. And because we're using these limits, we then set up goals to achieve our desires in the market, which makes a lot of sense. We're trying to simplify things. But by operating on statuses, we're not making decisions based on full information. We're making decisions based on just enough information and simplified values to give us enough satisfaction, not the optimal outcome. And so when we make decisions, we're really doing them in two phases. We have our framing and editing phase, where we come up with our idea, our trading plan, our strategy. And then based on how the market behaves thereafter, we are in our evaluation phase. Do I take profit here? Do I cut my loss? Do I move up my stop, and do I add in, right? But all these need to be done through that initial framework and preliminary analysis. There's a catch to that, but setting the catch aside for a moment, why do we want to do that? We want to use our framework by which we're using decisions because we want to have a goalie, a referee to keep us in check, to make sure that we're not kicking the ball out of bounds, that we're not deviating away from our strategy. Listen, sometimes market conditions change, economic regimes change. We can't deny that. But we also have to make sure that we're not getting bowled over by short-term volatility, by something that is not part of the plans, not in the economic calendar, not on the central bank speech. We have to have the ability to absorb that information and refine and edit and tailor our view on the market, and then go back and say, is our original plan and what we expected to happen, is it happening? And if it's not happening, the reasons for which it's not happening, do they undercut the validity of my point of view? Because if they do, then we need to perhaps reconsider the position we have. And that process is very much about going through our cognitive and emotional biases. And you may say to yourself, okay, I accept what you said about us having biases. We're not perfect. The markets aren't rational. But what about that efficient market idea? I hear lots about this, that markets are efficient. The price is always right. You know, I'm a big Bob Barker fan growing up on The Price is Right, 11 o'clock in the morning on CBS. Used to watch it with my babysitter growing up. And the idea here is effectively there's no free lunch in the markets, right? You just can't outperform consistently on a risk-adjusted basis. Now, I'm going to say that is in part nonsense. If you're someone who's a buy and hold investor, you know what? If you have a 30-year time horizon, you should focus on asset allocation rather than individual security selection. But we're not 30-year investors here. We're traders. We're trying to figure out how to navigate the market today, tomorrow, the next day, not 30 years from now, right? We're not investing in a company because we think that in 30 years, XYZ is going to occur. No, we're trying to take advantage of what's happening in between the bid and the ask, what's going on in the market now. We can put cash flow on the table now. And the reason why I don't think the efficient market hypothesis holds up, in particular for short-term technicians, they're traders, because it basically says technical analysis does not work. In the weak form, prices reflect all past public price and volume information. Only fundamental analysis and trading on inside information will work. And on the other end, the strong form, prices reflect everything. And even trading on inside information won't work. We know that's patently ridiculous. If that wasn't the case, how come the SEC and CFTC are consistently bringing down actions against individuals and firms for insider trading, where they've made a lot of money? I also happen to think that technical analysis does work. Does one strategy work all the time? No, of course not. If I had that figured out, I probably wouldn't be presenting here, as the saying goes. But there's no holy grail. Indiana Jones will never find that holy grail, because not one strategy works in every condition. So if you have a momentum strategy, a range strategy, a breakout strategy, you have to find out what the market's giving you. You know that there are certain exceptions to every rule. And so I do want to point them out here. Even as I say that EMH is mostly invalid, there are some tenets of it that actually hold up that you may want to consider when making your decisions. There is an outperformance of value over growth. That has occurred historically since 1945. That may not be the case in recent years over the past decade, but that does suggest that something is wrong in the way that we measure markets. Your capital asset pricing model may be wrong. Large cap stocks and large economies have proven to be more efficient than others. And because there are limits on arbitrage across financial markets, there are mispricings that exist and persist. And also, by trading in and out of things, you're generating transaction costs, and that could actually lead to lower performance because it consumes alpha. So over trading can work against you, right? Which is why they say don't focus on individual security selection, just buy and hold, right? Well, perhaps, again, if you're someone who's a long-term investor, why would you buy the S&P at the open every day and sell it at the close to do that every single day? I mean, that's ridiculous. But if you're a short-term trader, transaction costs are part of the game, unless you're comfortable trading with Robinhood and don't mind your data being sold. Alas, when we talk about efficient markets, can someone point out the rational person in this room? I can't. I see a lot of people that are trying to get each other's attention through multicolored jackets, through screaming hand signals, gestures. I don't know. I feel like there may be a better way than having a bunch of people standing around a circle screaming at each other at the top of each other's lungs to find price discovery. And I'm reminded of the scene in Trading Places at the end with the Duke brothers and FCOJ. Was that rational? Now, as we move forward here, and we're moving into the back half of this presentation now, there are some ways that we actually go about making decisions that fit with certain models of constructing our approach to markets that you may or may not realize that you've been doing all along. You may have been actually taking a psychological approach to the market in a manner that was subconscious and unbeknownst to you. And there are a few here that, in the behavioral finance point of view of the world, there may be something that you identify with. And there were 4 in particular that I would like to raise to your attention, because at the end of the day, there is no one perfect solution. The idea behind behavioral finance, after all, is descriptive. It's about how we behave. It's about recognizing that we have cognitive limits and emotional biases that distort our decision making. So we are looking for the practical solution for things. And when we are choosing the right asset or security, we're implicitly going through one of these models of decision making to help lead to our final outcomes. The first of the four that I want to point out here, the consumption and savings model. The idea here is that investors, individuals, we don't save rationally. We value current consumption over savings. And so we do the thing that gives us satisfaction in the near term. I mean, who here's been on a diet? Who's cheated on that diet? I have many times. In fact, I was cheating on a diet earlier today because my current consumption and need for satisfaction is apparently much more prioritized in my life than needing to get in shape and lose a little bit of weight before beach season. You know, those are the type of things that we do in our everyday life, right? That you don't even realize that we're operating on satisfaction. But anytime that you tell yourself that you're going to stick to a plan and then you take a shortcut to do something else, to procrastinate, you're prioritizing your short-term consumption over your long-term savings. And with this idea, we basically, in our heads, we classify our wealth as our current income and the present value of our future income. We really think about things in tangible terms of where we are today, not where we may be tomorrow. Model number two. This may be for some of the individuals out there who approach the markets in more of a traditional way. I've talked about the classic Kappa model. And effectively, the behavioral asset pricing model is adding a sentiment premium. What is a sentiment premium? Well, for me, it's a confidence interval. One thing that we look at in determining viability of a forecast, viability of an asset class, viability of an investment decision, is to think about the confidence we have, and I say we as a consensus of individuals and market participants around a specific outcome. When I say non-farm payrolls is going to be 100K, and Todd comes on and says non-farm payrolls is going to be 1 million. Does anyone here on the call have confidence in what the number will be? Yet if Todd and I would both come here and say NFPs are going to be 500K, you would walk away with a greater sense of, I think that non-farm payrolls report is going to be 500K. The greater the dispersion of estimates around a forecast, the greater the uncertainty around a forecast, the greater the uncertainty around an outcome, the lower perception, the lower perceived value that we assign to it, which perhaps makes the recent price action in Bitcoin all that more interesting. I'll leave it to you to determine whether or not you think it's a fait accompli that Bitcoin will continue to go up in price. But we have entered this seemingly spiral, this positive feedback loop, where instead of having outcomes of institutions on one hand saying Bitcoin's a meaningless digital currency that's nothing and should be laughed at and deleted in your trash folder on your computer, and retail on the other hand saying this is going to replace fiat currency, that was the conversation about a decade ago, to today where institutional flow has been equal to or greater than retail flow in the cryptocurrency space in the last few months. All of a sudden, the dispersion of estimates around the future outcomes, around the future value of the asset have been reduced, which means the present value of the asset has gone up. There's no more of this great divide around the future of Bitcoin. We're past the Rubicon. We've crossed the Rubicon here. No longer will we turn back. We're in a new world now. And now that this dispersion of estimates around is Bitcoin real or not has been eliminated, there's great confidence in its value that it will go higher. I think the psychology of the framing, when JP Morgan came out and said Bitcoin's going to be worth $100,000 in a few years, it's a big change of pace from where they stood a decade ago. Moving along here, we have behavioral portfolio theory, which is just, a fancy way of saying goals-based investing. What we tend to do, and this is not so much applicable to trading perhaps, but we tend to organize things in a fashion where, we have our reach goals, our stretch goals. We put those in a bucket with our lotto tickets. And with the things that we really need to handle today, we put funds behind them that are low risk. What do we pay for? What do we pay for our mortgage with? Usually our salary, right? We're not going out and buying literal lotto tickets and hoping that we're gonna get a scratch off that pays the mortgage to keep the roof over our head. That's a high priority goal. Maybe you want to get that new car. Maybe you want to get that Tesla. And you say to yourself, I'm going to go out and buy that lotto ticket. And it's a low priority goal for you to get a new car. So you'll do something inherently very risky. You'll take out a few calls on GameStop. Low priority goals, the reach things that we want to do, are inherently funded with riskier decision making, with riskier assets. And we tend to chase our high priority goals, the things that we can't afford to lose, with the safest cash flows. You may notice that you go about this in your trading when you are looking to get back on track after a series of losses. You may find yourself trying to execute a simpler trade, right? You may take lower risk. You may reduce your position size. That way you can just start to get some confidence under your belt. The high priority goal is to avoid risk of ruin, to avoid blowing up your account. And so then you start taking less risky trades. Interestingly enough, because investors tend to either go to the bottom of the totem pole and look for safe assets to fund their high priority goals, or they tend to go to the top of the totem pole to fund their reach goals, it means that those things in the middle are often overlooked. They're often undervalued. In the currency space this year, I can't think of a better example of this than the British pound. In what conversation is the British pound called a safe haven asset? In what conversation is the British pound called a growth asset? And yet it's been the best performing G10 currency this year. It doesn't fit a mold of risk on or risk off in the traditional sense like your Australian or Canadian or New Zealand dollars do, or let's say the Swiss franc or the yen or the US dollar. And yet it has been a high flyer. People weren't looking there. It was a moderate risk asset among the currency spectrum. And lo and behold, with the benefit of hindsight, it was clearly undervalued. Now, moving along here to the final 4 points of the portfolio construction decision-making, adaptive markets hypothesis. This is much more freewheeling, but it actually is a buildup. AMH is effectively EMH, the efficient markets hypothesis, adding in bounded rationality, adding in satisfice, and topping it off with a nice cherry of evolution. You adapt or die. If you're not flexible, you fail. If your trading strategy is round peg and all of a sudden the market is a square hole, you are done. I've said this before. There is no holy grail. I'm sorry, Indy didn't get it. Nothing works forever. And in this case, that's the mindset, that you are always willing to approach the markets to not just achieve your short-term goals, but to ensure that you have the ability, the opportunity to achieve your short-term goals. You don't want to run the risk of ruin and not have a chance to engage in the markets. So AMH is effectively saying that, yes, we believe in some of these tenets, that markets operate in some organized fashion, but there are limits to that because we don't know everything. And not everyone operates in a rational manner. They do things to satisfy their short-term wants. They prioritize near-term consumption over long-term savings. And effectively, if people don't shape up or ship out, they're done for. I think this is a really compelling way to think about things. Am I approaching the market the right way? Perhaps this is a way to do some self-reflection, right? Am I being inflexible with my point of view? Am I illustrating various cognitive and emotional biases? Now, I will say that everyone's biased. We all have biases, right? I think every single year that this is going to be the year that the Mets, Knicks, or Jets finally get it together. I can't shake that bias, no matter how much history teaches me my lessons. But we all have our opinions on things, by virtue of our experiences in life, where we come from, how we were raised, what we learned, that's part of human nature. And so under traditional finance, the rational economic man is making decisions perfectly, of course. But under this framework of behavioral finance, decisions are imperfect, right? And these imperfect decisions can be impacted by either, cognitive decision making or emotional feelings. And some biases may be both. It may be the case that you'll find that cognitive errors are mistakes in thinking which are easier to correct than your emotional biases. Because emotional biases, they're impulses. They can be social factors. They can be something as simple as seeking pleasure and avoiding pain, i.e., cutting your winners early and letting your losers run. That's a very emotional, irrational thing to do. Cognitive biases, however, there's a difference, right? We don't have the proper information. We don't know how to process the information correctly. We have a series of shortcuts or heuristics set up in our mind to sort through our values, and they lead to, again, bad outcomes. Maybe we just forget things, memory errors, right? Traditional finance says that these things are not possible. I certainly forget things. My wife reminds me of that a lot. If the traditional finance view is correct, then actually she's been wrong. So maybe I should be adhering to that. But jokes aside, memory errors are real. People have them. I have them. You have them. We don't have perfect information. We don't have perfect education. The human experience is ever changing. And so too is our ability to engage with the market. Now, when we go through these cognitive and emotional biases, again, some of them are going to overlap. This may be a little dense. And as Todd said, we're going to make these presentations available via recording. In fact, I'm going to see if we can make sure this slide deck is available for download as well, if that's possible, because I think this is useful information. I keep this with me, a little card of these biases literally in front of me when I'm doing my positioning review. Should I stay in this market? Do I need to add more here? Should I reduce my risk there? Because I want to be aware of the fact that there are subconscious influences that I may not have in front of me at this time. And I need to really be aware of what's going on around me and not, again, trade against the market, but make sure I'm not trading against myself. So what are some biases here for cognitive? These are the belief perseverance biases. Number one is conservatism. It's anchoring. You have a rational view initially, but when new information arises that contradicts your point of view, you're reticent to update it. You hold positions longer than you should before ultimately you come around to the piece of news or information that, the technical threshold that was breached before you ultimately change your holdings. Confirmation bias. It's where we actually go in the world and only look for things that confirm our point of view. If you're a liberal, you only listen to MSNBC. If you're a conservative, you only listen to Fox News. If you like the Mets, you only listen to SNY. If you like the Yankees, you listen to Yes. I mean, I'm using these specific analogies because it's the exact problem that we run into, and so many of us are facing, perhaps on a societal level today, that people only go into their echo chambers. We only seek out evidence to find supporting views for what we originally believed. And so our screening process is designed to basically keep our blinders on, to make sure that we can only find what we want to find. And that's incredibly risky, of course. Representativeness bias. This is when we tend to say something is new. We see something that has just come across our radar and go, wow, this time is different. And unfortunately, this tends to lead to us mismeasuring things. Base rate neglect or sample size neglect is an important point of this here. We tend to extrapolate something that's happened now as representative of the whole, and it may not necessarily be true. It's why, from my point of view, whenever I start getting really ginned up about interest rates and the move that we've had recently, I go to a 30-year bond chart or a 10-year bond chart and I go back and look into the 90s or 80s or 70s, if you're interpreting the recent move as, oh my God, rates are going through the roof, what are we going to do? The economy's going to burn to the ground. Maybe take a step back and look at the longer term perspective here. Maybe what's happening today, we're blinded by the fact that we have sample size neglect. Control illusion is my biggest hurdle personally. This is the idea that we are in more control than we actually are, which means that because we think we're in control, we can guarantee success. We overestimate our probability of success whenever we get involved with something, right? Why else would we get involved? So we can go lose? No, because when we get involved, we go to win. Well, this control illusion is very harmful because it leads into another issue, which we'll get into 2 slides, which is about the endowment bias. Basically, if I'm in a security or asset, it's worth more, it's going to go up, the trade's going to work out. And quite frankly, does that line up with the process that you aligned originally? Go back to your initial strategy when you're doing your framing and editing process and designing the trading strategy. Now that we're in a live environment, where do we actually stand relative to our expectations? Don't assume now that because you've made the decision to get into the market, things are just going to work out well. We always need to be constantly keeping in check the fact that we are just mere small fish in this pond. In hindsight, this is a killer. We tend to look back at the things that we did well, and we have this ability to neatly package up, digest, and throw away everything that we didn't do well. So you remember the good trades, you forget about the bad ones. Hindsight bias, if we are not constantly reviewing our strategies and whether or not they led to success, our decision making and whether or not that led to success, we can get arrogant. We can trade too much. We can take too much risk. I know maybe hearing from others on this call, my God, you're telling people not to trade. Well, no, not necessarily. There's a sweet spot, right? When you are making the decisions, you're trading when it works for you to give you the most or best chance of achieving your goals. That's when you should be trading. So when we only think about our successes, we then think that we're in control of the market and that we can take any trade and it will all work out for us no matter what. We take too much risk. You want to avoid that. The hindsight bias for me was actually one of the more important tools in my learning process over the years. Doing a review of my performance outcomes across different strategies and timeframes was perhaps the single most effective thing that I've done for my own trading results, because I stopped doing the things that were weighing me down. My hindsight bias was that I was literally forgetting about the times I was taking scalps and they were turning against me, because I was so committed to the notion that I could be a good trader on any time frame in any market that I thought I was in control. And so by reviewing the past, I was actually able to discern that I'm not that great of a scalper. It's actually my least successful time frame to operate on, which is why I've deviated away from it. And just by simply doing the thing that is hurting me, I've been hurt less with my performance, right? My dad had this old joke, a man with a sharp stick in his eye goes to the doctor and says, "Doctor, my eye hurts." And the doctor says, "Have you tried taking the sharp stick out of your eye?" And the man says, "No." Well, maybe we should stop doing the things that are weighing down our ability to perform in this market. And for me, that was scalping. More cognitive biases here before we jump into the emotional ones. Quick 4, anchoring and adjustment. Anchoring is a really powerful trait in human psychology. Often the first thing we hear becomes the reference point, which all future decisions and conversation has had. It's why one of the things that executives do in companies, politicians, leaders in any sense, is that they put out their vision for how the company should proceed over the next year or 3 years or 5 years. That way, future discussions around how things should perform are based around that plan, right? The problem sometimes is that if you are too committed and anchored to your initial point of view, that as new information arises, you don't adjust your game plan accordingly. Quick enough, fast enough, significantly enough, you're a day late and $1 short. Which is why, again, keeping a written record, perhaps a detailed record of the process that you're supposed to be adhering to and why that was done. And you can go back and review your strategy and make sure that those conditions still exist. If not, have a filter to figure out an adjustment that needs to be made. Mental accounting. This is something that I think everyone falls into, but funds are treated differently depending upon how they're classified. This ignores potential to reduce overall risk through diversification. Ignores the fact that total return determines success. How does this affect you? It may be the case that you say, well, I have X dollars to put into the market, and because I have, half of them in stocks and half of them in bonds, I'm fine. Well, maybe not. Maybe what we should be doing is not looking to just go into stocks and bonds, but we should be thinking about how we are putting our money within stocks. Should we be going into financials? Should we be going into utility? Should we be going into industrials? What about the fact that instead of simply going into stocks versus bonds, we think, oh, those funds and stocks are riskier. We actually can change our portfolio allocation to reduce our risk. Investors need to not get caught up in the idea that it's a black and white world, that they don't have the ability to have nuance in their decision making. You don't want to fall into the trap where you simply assign too many shortcuts and heuristics to things to simplify your classification process. Because then when you classify things too broadly, you undervalue, as we talked about before with behavioral portfolio theory, you undervalue the things in the middle. Framing here, the way that information is presented determines how you interpret it. This is so easy, but if I were to put a period at the end of a sentence versus a question mark versus an exclamation point, it totally matters. If I were to tell you the market's up by 0.2% today, is that a good thing or a bad thing? You'd say, okay, 0.2% higher, probably a good thing. What if I told you that the market was up 0.2% after being up as much as 3%? All of a sudden, the framing of this information is different. The market, yeah, it's up by 0.2%, but it did so by declining from nearly 3% of its daily high. On the other hand, what if I said, yeah, the market's up by 0.2%, but after coming back from down 5 yesterday, all of a sudden that 0.2% gain looks very different. A 0.2% gain after a 5% trough is framed very differently than a 0.2% gain after a 3% pullback. The way that we are presented information matters. And if we focus solely on the short term, if we focus explicitly on how we're interpreting this particular one piece of information, and we are not taking that step back, we are going to misidentify risk in the market. Plain and simple. If we don't have the right framing, we will not understand what is going on around us. So don't just look at the 0.2% close. Take a look at the daily candlestick. Take a look at the weekly candlestick. Take a look at the monthly candlestick. Look at the trading volumes over the course of the day. Look at how the market responded around specific data releases and events over the course of the day. But data presentation matters. And this feeds into the next point very fluidly, availability. We make our estimates for success or failure in the market based on what is most recently available to us. What's familiar? What's easy? What do we know? What's at the top of our mind? If we're in a really good market, you're probably going to think that the market's going to go up. And if we're in a really bad market, you're probably think the market's going to continue to go down. We are ultimately doing these framing decisions based on what's in front of us today, what's easy to recall. which is why I think it's so important to constantly, decompress, if you will. Get away from your short-term or medium-term or long-term time frame and move into an area where you can get away from the familiar. You can find yourself a little bit uncomfortable. I have a few more here on the emotional side, and I think these are much easier to go through. Loss aversion. People hold their losers too long and they cut their winners early. It leads to overtrading and increased risk. We don't want to do that. Overconfidence. We have way too high of an opinion of our own abilities, which means we take too much risk. We expect too much in return from the market and never gives it to us. Self-control, emotional bias. It's a lack of self-discipline to delay gratification in pursuit of those long-term goals. We are undercapitalized, right? Because we're not saving, we're spending, we're consuming today. We're not saving to invest for tomorrow. Lack of discipline hurts our ability to protect our capital. Status quo, well, what's comfortable, what exists is comfortable, so might as well not do anything at all. Endowment bias. When I own something, it's worth more than when I didn't own it. If I were to buy Apple today, if you were to buy Apple today, a little subconscious thought in the back of your head will now say, you know what, it should go up tomorrow. It can lead to thoughtless retention. Just because you've owned a stock for 10 or 20 years doesn't mean it's worth a lot of money, right? I'm sure there may be some people out there who have a nice warm spot in their heart for General Electric or IBM. I'm sorry, those companies aren't doing well because they didn't adapt. They're dying. Thoughtless retention. I've owned something for 20 years. Avoid that. And then regret aversion. Avoid errors of commission while ignoring errors of omission, right? We would much rather avoid making a mistake. I would rather not take this trade and lose money than me having made the decision to avoid a trade that would have made me money. My bad. I should have known to take this opportunity. I didn't do it, but I'm going to forget about that. I'm going to forget that I have made mistakes. And so I'm going to put my blinders on. So if you ever find yourself ignoring your losses, you are in regret aversion territory, you're in loss aversion territory. Please go back to the drawing board and check yourself, because you can help improve your own performance by recognizing you are misleading yourself. And we've all been there. We've all been there. And I say we've all been there because, as I alluded to before, I've had some painful processes. I can tell you what happened in 2011, on September 6, 2011, when the Swiss National Bank implemented the floor in Euro Swiss at 120. I, at the time, lived 6 minutes from the office. I was walking to work at 4:25 in the morning. I got to my desk at 4:31. At 4:32, I heard someone running down the hall screaming. And then I looked at my Euro Swiss chart, and yeah, sure enough, Euro Swiss was from 108 to 120. And I was way too levered up. And it was because I was scalping. And that hurt me. And as the years went by, I ended up noticing anecdotally, the more I scalp, the more my account profitability is moving sideways. And so we started having these conversations, and my colleague Ilya Spivak for years has talked about this behavioral science nature of the market, behavioral finance. How can we figure out what we are doing, why we tick the way that we tick? And ultimately, over the years, we put together this quiz that's available on DailyFX, which is known as the DailyFX quiz. We ask you questions unrelated to trading about how you approach certain situations in your own life outside of markets. And these will implicitly reveal a deeper truth about who you are, about how you view things in the world. And when I took this quiz, I found out that I was a position trader. And then it clicked. No wonder my scalping results have been so terrible. I'm not a scalper. The way that I approach my day-to-day life is not one in which I can be so in and out of the market and be so disconnected from a long-term point of view. Why? Because of my education. I have a background in economics, in macroeconomics and political theory at the university level or college level here in the United States. A CFA charter holder as well under my belt. These are macroeconomic, long-term investing points of view, several weeks to months out, leaning on fundamental analysis, but we incorporate technicians to time our trades. Position trading fits me like a glove. And sure enough, as I've gone more into taking trades around this point of view, I found myself less stressed out because I've stopped employing strategies that led me to that cognitive friction, that emotional friction where I was making all these justifications for why I was not performing as well as I could have been. The DailyFX quiz is sincerely designed to help you arrive at that aha moment. You know, we want you to approach the market in the manner that, for lack of a better phrase, allows you to pass the pillow test at night, where you can put your head down and feel comfortable that the risk you have on the table is not going to leave you at risk of ruin, that you're not going to walk to work and see your account bloat up because of a bunch of bankers in Zurich. For me, avoiding my pitfalls, avoiding my own cognitive and emotional biases and fallacies and shortcomings has led me personally to a greater place of peace in my trading. Trading should not be this thing where we sit down at our desk and we feel like we have a gun to our head. And if that's how we feel, then we're probably taking too much risk. We're probably approaching the market the wrong way. So if I am allowed to offer any direct guidance, if you will, take the time to figure out who you are as a trader. It may be the single most important thing that you can do to lay the framework, the groundwork, the foundation for long-term success. Because if you don't, and you don't spend the time to educate yourself, and a whole host of us individuals don't take the time to educate ourselves, and we just decide to, look through the FUD and, YOLO our money on GME calls, which, is a heck of a thing to keep an eye on over the last several months. And, as a Reddit user myself, I can tell you I've been looking at the Wall Street Bets forum for several years. Tracking this from the beginning has been a very interesting real-time experiment in manias. And when biases get out of control, that's when we get our manias. Greed clouds our judgment. I know there may be some people here thinking, well, we've all seen the movie Wall Street. Gordon Gekko said greed is good. Yes, perhaps, but here's a different perspective. Greed can lead to us making irrational decisions because we hear that someone else has made a lot of money in the market, that our neighbors have the new car, they have the bigger house. And so we have that fear of missing out. We get that FOMO, as the kids say. And we've had this situation building for the last year or so. When the economy shut down in spring 2020, we also had sports markets close. If you're a sports gambler, as actually my brother's a professional sports gambler, you're the kind of person who likes to take risk. You're looking for action somewhere. And with betting markets closed, we're better an outlet than financial markets. This was a whole new wave of liquidity that's otherwise been out of reach of traditional financial markets. We've seen Tesla go up at 1.8-fold plus, Bitcoin past 60,000. Gold and silver have one's traded to a fresh all-time high and then cratered right back down. The other's moseying about like nothing's ado. We've seen copper prices surge. We have inflation fears going through the roof all of a sudden. We have Robinhood putting out promotional information about how you can deposit your stimulus checks with their brokerage. The market is aware that more liquidity is coming. The market knows that a lot of irrational people who have never participated in financial markets, who were not here for the last boom bust cycle, have arrived. They are now participating. We have, for lack of a better phrase, a bunch of inmates running the asylum. And this is not the first time it's happened. And why do we know that? Because human beings haven't evolved that much. The brains that we have today are more or less the same ones that the Romans had when they were running around, or the ancient Egyptians had when they were running around. What we feel today, the anger, the sadness, the fear, the hope, these are the same emotions that human beings over the millennia felt. Now, sure, our technology may have changed. We now have better hastened financial markets. Information flows a lot more freely across national borders, across continents. But the emotions that govern our biological hardware are still the same. And so there may be historical episodes that we can learn from. I mean, my dad would always say to me growing up, silly people make mistakes and don't learn from them. Regular people make mistakes and learn from them, but smart people, they learn from the mistakes of others. And so we can go back to the history of financial markets to see how manias evolve, how biases, both emotional and cognitive, get out of control. Because at some point, as we know, the music stops, the punch bowl gets taken away, the mania ends. The foremost mania that we think of is the Dutch tulip mania, which, by the way, was driven by out-of-the-money call options, believe it or not. Now, this was a bubble unlike any other, because at its peak, some single tulip bulbs with no real economic use sold for more than 10 times the annual income of a skilled craft worker. And this is what I call the bubble ratio, right? For reference, at the time this was written, Amazon shares were trading around $3,000. For the this to be valid, the annual family income would need to be about $300. And in America, the annual median family income is around 60K. So our bubble ratio is 0.05. We talk about a bubble, Dutch tulip mania. The average bulb was 10 times the annual income of a skilled craft worker. And of course, within the end of 1636, bulb prices had come down from 60 to less than 1. 1929 Wall Street crash, nothing perhaps more famous in American history than the run-up at the end of the Gilded Era, one which we are now saying the 1920s will result in for us here. Spectacular drop in the market, 497% run-up in the decade prior, and then in just 2.5, 3 years' time, we get 89% back down to where we were, below where we were in 1921. This is the Great Depression, after all, and it's through a combination of extreme government spending and the war, World War II, that the economy is finally able to pull itself out. But a decade of excess leads to a very violent decline. And more recently, of course, we have the era of deregulation in the 1980s under Reagan and Thatcher, leading to what inevitably is the internet bubble. And from 1990 to 2000, we see the NASDAQ gain 1,450%. And in the following 2 years, we lose 78% of that. 78% of its value is gone relative to the March 2020 high by late 2002. And again, why do bubbles pop? Perhaps investors started to come to some sense. Perhaps it was also involving the September 11th attacks. Perhaps it was Y2K. There are a number of reasons you can point to. But the lesson is that sometimes bubbles just pop. Mark Twain has a great saying for all this. History doesn't repeat itself, but it often rhymes. I've said this before, but the emotions that govern our predecessors are the same ones we deal with today. Greed, fear, excitement, disappointment. We're dealing with this all in a very rapid sense these days in a global marketplace connected at the hip by the internet. I could tweet something out right now that someone in Machu Picchu or in Tibet or in Johannesburg or in London will receive effectively all at the same time. My point is that if history is our guide, if only by rhyme and not repetition, then we should be wary of the fact that as information flows more freely now than ever before, we may be more susceptible than any other time in history for manias, for bubbles, for crises, for crashes to occur and to develop. And so as you navigate these markets, these frothy markets with historically high PE ratios, Be aware of your own emotional and cognitive biases. Look inward, not outward. Think about how you tick. Think about what's influencing you and driving you to make your decisions. And after you do that, please come visit me on dailyfx.com and go visit Todd and Dan at Nadex and take up all the information and education content that we can provide you, because we want you to be good decision makers. There is nothing more endearing, nothing satisfies me more personally in my job when I come on to a client event and I see someone who I've talked to before many times for the past year, for the past 5 years, because it means that they're successful. It means that I'm helping them. We, DailyFX, IG Nadex, are helping them in some form or fashion make better decisions, to help them stay afloat, to help them achieve their goals. That's what we are here for. That's what we do. You'll find us across a number of mediums, live webinars, written research, video, seminars like these, but we are here to help you become better decision makers. And so my point of view is look inward. Figure out ways that you can master yourself before you master the market. Because if you can overcome your own biases, you will eventually get to the place you want to be. Todd, I have to say, today was a terrific run of events. I appreciate that you gave me the time to run over. I did say I was going to be longer than this year.
No, Chris, thank you so much for that. It was, and I wanted to give you that room and that rope for you to make sure that you got it all across. And that was definitely an intellectual approach to behavioral psychology and how we approach the markets. I can personally say that I have no biases. I'm always rational, and I never make mistakes. I mean, well, once I thought I did, but I was wrong.
Well, see, there you go.
So thank you, Chris, for that. And that was really a great way as a keynote and an anchor to bring it home today. I want to thank you so much for that. I know people really appreciated it. You mentioned, if someone wanted access to the decks, I've given this out all day long. If anyone would like a copy of the decks from any of the sessions today, you simply need to email customerservice@nadex.com and request it. I will make certain that they've got copies of all the decks, so whichever ones you would like, you may request. Again, the entire day was recorded. Give me a day or two to render the recordings and process them and get them posted. You will find the recordings on nadex.com under Learning Webinars, and they'll be in the archive. With that, I really want to thank everyone for joining us today. What a great day. It was a long day, but it was a lot. So you will be able to go back and review this at your leisure. And we'd like to thank you for joining us at this Nadex event. And for those of you who are customers, thank you for being customers. For those who aren't, be sure to open up a demo account and test your hand. Open up a demo account. And I also want to remind you, I put this slide up several times today. We do have that refer a friend program. So hopefully everyone who does open an account takes advantage of that. There's money to be had. With that, again, I want to thank everyone for joining us. A reminder, 8:45 a.m. Eastern, 7:45 a.m. Central every morning. We live stream on YouTube. We do some morning analysis on hotspots in the markets and where you might want to look for the day. Thank you again, and I want to wish everyone good luck in the markets, and hopefully we'll catch up with you later.